Welcome to Lighthouse Outlook, the podcast where we talk less about the markets and more about what matters to the people navigating them. From family offices to founders, we go beyond the numbers to unpack risk, legacy, and the human side of capital. Hosted by the team at MacNicol and Associates Asset Management.
Happy New Year, everyone. And happy birthday, Ken. Okay, January, 2026, moving quickly here. Already a number of meetings with clients and prospective clients, so that's great. Just a couple of updates this week from the Absolute Return Fund. We're sort of in our kind of year-end wrap-up for 25 in the alternative space, so we'll take a look at what some of the alt partners are doing on the hedge fund side, and then get into charts of the week. As usual, we're not providing advice here, tax or investment wise or anything like that, but we love to do it. So come in and see us. Wrapped up the year at just a hair under 24%, which is great net of fees. And reminder that Contrarian is our sponsor in the emerging market distressed debt area. So certainly with a lot of the geopolitical risk going on there, I'm sure we'll be hearing quite a bit more from Contrarian. So that's great to get the 23 and change for the year. Really helps the cause. Mike Coolbaugh, Strom Cap Fund 1 is to the end of November, out just under 10%, which is great. Mike's strategy is global macro. And I did have a quick chat with him yesterday. The December print should be in that sort of 275, 285 basis point range. So he should hit right around 10% plus for the year. And we are one of the original unit holders of his fund. So the inception to date number 27.6, which is great. And we'll probably do something with Mike in the new year, just in terms of global macro type of overview. So should be really interesting to see what he's talking about. This chart is from BSP Funds. They are our diversified. So if you go to the Absolute Return Fund and you look at one of the bigger pie slices in the chart, it's going to be this group, and this is essentially a diversified hedge fund strategy. So there's about I think 14 or 15 hedge funds in this overall strategy. Equity long short being the largest, followed by I believe convertible ARB. And you could see the print. Now, this is one of those tables where the bottom line is actually the most current. So their December numbers were good. They should also hit about 10%. But what I wanted to draw your attention to was the next slide, which is the same table, but this time focusing more acutely on their STA program, which is basically systematic algos and trading. It's essentially a statistical and momentum-based strategy. 481 is okay. And again, their December numbers were positive. I did check in with the company yesterday. So they should hit, pretty close to 5. 5 is positive. Of course, in kind of 2025, most of the major markets were up, 3 to 5 times as much. And so, what are the main explanatory variables for them trailing? Like in 24, they did over 14%, which is great. But with trend following, not to pull up stuff from business school, but trend following programs do tend to underperform in sideways or range bound markets. They also have little bit of slippage or difficulty chasing these V-shaped reversals like we saw shortly after Valentine's Day last year, and then definitely in March and into April when Trump was sort of lobbing grenades at other countries. And the reason for that is the computer algorithms, the models essentially move to cash after a correction has happened, and then don't get reinvested until a new trend is established, which sometimes happens after the bottom part of the letter V. And then they also have difficulties in strong bull markets with few corrections. I think maybe these 2 points, the second point and the third and the fourth point, describe 25, but positive nonetheless. So happy about that. Looking at charts of the week. So Andrew sounds like he's back in action, a little bit of a leaner print this week, so only a couple of pages. He's talking about the S&P 500 once again striking a new all-time high. He really wants to see that follow through and that strong demand. On the other hand, if you get a break of last week's low in that 68.20 range, he could be quite concerned. So just breezing through some charts, as I say, not a lot, not a very detailed report. But here we go with the S&P 500 up over that first standard deviation line of the 50-day moving average. So that's positive. Looking at some of these indicators here, I think, the main one is definitely going to be the semiconductors starting to lead the S&P early on, which is typically a good signal. And then he again wants to see a definitive breakout outside of this pattern for the S&P 500 rather than people using strength to unload and dump stock. That would really fizzle the rally in his opinion. And then the last one for me is, again, just this more kind of deeper look into the SOX semiconductor index. I guess the value here is it has broken out. So this double top, or what was formerly thought to be a double top, has been broken. That's a positive, and you can see in the lower panel that's actually positive on its own relative to these bands and the various toppy points, but also relative to the S&P 500. So overall, looks like a pretty good start to the year for stocks. It's just got to keep moving. And then, of course, he's always looking for situations in where you get sort of a false breakout. So that's it for me. Maybe we'll pass it over to the birthday boy at this point.
Thanks, Joe. Yeah, I'll try to be pretty quick here, just with the 3 weeks off. Same disclaimer as Joe, and then just a U.S. disclaimer for our U.S. viewers. Be quick through these indices. The S&P just had a 4-box increase, new buy signal at the top there, so new all-time high on the chart. I mean, looking back at the year of 2025, on April 8th, the S&P 500 was down 15% year to date. It was down more from its peak. That's the fourth worst start to a year since 1928. I forget how many trading days that is, but that's what the data set used. And then the finish the year up, obviously 16%. Really in the middle 3 months of the year. And Dorsey Wright had a study in regard to just the velocity of that move in the middle of the year. Was one of the fastest we've seen in decades. Obviously, one of the faster ones also being the recovery in COVID. Nonetheless, market obviously driven by Wall Street. AI and materials really are the 3 areas that had really strong years. On a technical outlook, has some nice support lines here. Overbought, oversold, returns to overbought, which is positive, but momentum breaking down. And in comparison to a few months ago, demand levels in terms of overbought, oversold, much lower. Looking here at the NASDAQ, it had a 5-box reversal over the last 3 weeks. So a bit of a slower holiday period, which is no surprise. It's back to its December resistance and 2 boxes from its all-time high. It has some strong support lines. Last year was up about 21% on the year. On a monthly basis, the momentum reversed. The overbought oversold was at 17%, which is the highest in 5 weeks. And for the most part, I will say tech has gone a little quieter in the last few weeks, maybe just over Christmas. Maybe that was a holiday fact. But there are some whispers I saw this week in regard to CoreWeave and their potential outlook, and some trouble brewing in terms of liquidity down the line. So we'll have to see if that is true or they're just overall whispers. Looking here, the Dow Jones, 3 column changes over the last 3 weeks. So the largest moves also broke out above the resistance and had an 8-box increase, creating a buy signal, which is the second straight for the Dow. There is some short-term support, 8 boxes lower. In terms of the momentum and overbought, oversold, and a number of technical indicators, the Dow does look to have the most value, and it has the strongest outlook. In terms of a trailing 12-month PE ratio, we're still actually below the PE ratio we were at 1 year ago today. So obviously at elevated valuation levels, but when you compare them historically to peaks, still some obviously upside to go if you're trying to match previous high in valuation. Looking here at the TSX 60, 6-box reversal, new buy signal. That's a third straight. Continued breakout to the upside, which is a positive sign after kind of that slow October and November. And then even December, really TSX seeing its next leg up. Obviously, this strong year has continued for the TSX in regard to materials. We think there's a continued flight to safe havens, which is why some of these miners have moved so well already this year. Support 6 and 12 boxes lower. The PE for Canadian equities for the TSX 60, according to FactSet, still 20x. Technical outlook remains really strong, despite some weakness in the Canadian energy market, obviously stemming from Venezuela. Overbought, oversold 61%, and continues to remain elevated relative to US indices. VIX, not a whole lot of changes here. The target decreased to 17.5%, which is actually above where it sits right now. Over the past, say, 6 to 7 weeks, we've seen this move lower after a few months of breakouts. We'll have to see if that continues. Obviously, we're one geopolitical event away from a massive spike in the VIX. Bullish percentage chart, not a whole lot of changes here, so I'll just keep it moving. Percent positive trend, both of these charts moving up, which is a positive sign for both growth and value here, being the NASDAQ and Dow. These charts are a little delayed in terms of how they move. And then the Toronto Stock Exchange bullish percentage chart moved up further this week to its highest point since, I think that's May of 2021. And the percent positive trend, kind of a similar time frame. So really, like I said, the outlook for Canadian equities continues to improve, and we continue to get more bullish on certain areas of the Canadian equity market. I'm looking here at the asset class rankings over the last 3 weeks. Not a lot of changes in terms of buy signals overall. The US dollar did lose a buy signal for the first time in a few months. Emerging currencies actually gained that. There's a lot of movement within the fixed income space in terms of losing and gaining a few buy signals here and there. And then industrial metals picked up a number of buy signals. Energy lost a number of buy signals due to some weakness in oil, obviously. US arresting the Venezuelan president and quasi taking over Venezuela, or I guess monitoring the situation or whatever they're doing. It seems a little unclear, but nonetheless, you can also see here energy, 117 buy signals. In the US, there was some strength in certain names over the last or I guess four trading days. Obviously, the refiners and the majors could be major beneficiaries of a more pro-Venezuelan, more pro-US Venezuelan government that wants to actually increase production and not be as corrupt and kind of return to their former glory, or at least a fraction of it. But the energy sector has picked up, I think, about 40 buy signals in the last 3.5 to 4 weeks. It was closer to the real estate number at 58 at the start of December. So despite not moving up in the rankings on an absolute basis, in terms of picking up buy signals, it's moved up pretty substantially. So something to watch there in terms of US energy equities. Just looking here, a couple charts to review last year. This is a chart from Charlie Bolello, looking at the returns of various asset classes, S&P 500, obviously, emerging market stocks, which we actually owned the ETF across several accounts last year. And then the European stocks, obviously, strongest performing. We didn't have much exposure there. But you can see the S&P 500 versus the MSCI World Index, except the USA. The annual returns last year, there was almost a 15% greater return in that MSCI ex-USA ETF. That's the largest spread in terms of the MSCI outperforming since 1993, and you can see back here in the 80s and 70s for in various times that occurred as well. But perhaps some rotation away from this U.S. exceptionalism. I've seen a number of larger managers pushing for increased diversification within the equity portion of an investor's portfolio, including Ray Dalio, who said he would avoid U.S. large caps and mega caps in 20. We won't go that far to say that, but I think having some international exposure, including up here in Canada, could be really beneficial for investors.
Ken, interrupt for a sec. Go back to that slide because it's really powerful. One thing I'd like to find out, maybe you could even write to Charlie Biello if they could do this in all in US dollars, because before the EU, you had dozens of different currencies working in the MSCI. And so when you see those red areas where they've outperformed the S&P 500, that's probably, it's true on the just the stock price differential, but the currency swings would have been dramatic in some of those years. So I'd like to see this on a US dollar based and see if it really continues to favor the US or the S&P 500. So maybe you could ask them that or see if you could dig that up.
Yeah, I'll email them. I know the actual ETF, like this ETF, this strategy's in ETF right now, and it's all priced in US dollars. So it's obviously not been around since the 70s. So maybe they indexed it back to there, but I'll email to make sure.
Yeah, just ask them, and maybe I'm wrong. Maybe it's already cooked in just all in single US dollars. So, okay, very good. I like that chart.
No problem. Yeah, so just quickly here on the US dollar, Trump obviously getting his way. Said for months down the campaign trail and previous to his assuming the White House, he was going to devalue the US dollar. I mean, he did. The US dollar had its worst year since 17, down 9.4, almost 9.5% when you're looking at the US dollar index. And yeah, I think that it was a policy that we foresaw. Obviously, the Canadian dollar hasn't benefited from that. It's been one of the other currencies across the world that has weakened. But I mean, for Europeans and even other international investors, nice little swing there in terms of currency appreciation relative to the US dollar, potentially if they were positioned properly. Looking here, this is the S&P 500 P/E ratio on a trailing 12-month basis dating back to 1988. Obviously, some cyclical swings here. But you can see where we are right now at about 26 times earnings. Back in the early days of COVID, we got up to 31, which is a bit of an anomaly. So we'll kind of price that out. But you can kind of see we are approaching those highs from the dot-com era at 29 times earning. And you can see this the historical median, obviously, only dating back to 88, being below 20x. We're in an environment that is obviously valuations are a little more elevated than compared to historical valuations. Some of those driven by innovation and growth rates, some driven by, I think, pure investor hope, but we'll have to see what happens. This is a chart from the Bank of America Fund Manager Survey, I think. This came into my email over the break. I think it's the November fund survey, so it's a month out of date, but it still nonetheless drives my point. Passive is nearly about 60% of the US AUM right now in terms of allocation. When you go back to 2009, passive made up only about 20%. So you were seeing this wave of retail traders entering the market and kind of they've tested out day trading and the crypto markets and high risk leveraged ETFs and single names like Tesla. But there's also a chunk of retail investors and individuals and even wealth advisors that are just setting it and forgetting it, and in an index fund that is more concentrated than ever and is susceptible to some of the same single security risks that if you were just to own a small basket of stocks. So I think right now, especially with markets at all-time highs, it's important to have some sort of active management within the portfolio. Now, this is more for just people on this call, but just a number of the worst performers on the S&P last year, just for potential bounce back candidates. Obviously, a number of these I would stay away from no matter what, but a number of them really saw dramatic pullbacks for reasons that potentially could change, I will say. Or not for reasons that could potentially change, but there could be an overall turnaround for a number of these firms where results could improve, or a strategic shift has already begun. Just looking here at gold, this is the price of gold on the right, obviously basically at all-time highs. Last year in terms of value, gold at the end, it was either right at the end of 2024 or at the start of 2025, regained itself as the largest asset in global reserves at close to just surpassing the US dollar, obviously, in terms of percentage of assets. A lot of those Eastern nations, we'll say China, India, continue to pile into gold. We think that trend will continue. It's a safe haven. It provides stability in terms of, or in times of conflict and geopolitical tensions. And we think that even with the run up gold has gone on, there could be higher prices seen over the next few years. And then looking past the physical price of gold, just looking at mining equities, it's a chart from a number of groups in their year-end letter. It's a little out of date, but if you were to guess at the percentage of global equities in the mining industry, in 2021, it was 1%. There's estimates that it sits at about 3% now, 2.5%. So it's increased obviously with the run mining equities have been on. But compared to previous cycles, we're nowhere near that high. And it seems like there's more demand than ever for these precious metals, for metals, but especially precious metals. So I think if you're still looking at exposure, adding some exposure in the precious metal mining spaces presents a strong opportunity. Especially if you add the right names. Looking here, nuclear energy, this from Bloomberg, new article, I think yesterday or the day before, talking about how much money on the right the US will spend on nuclear power growth through 2050. You can see a lot of the money is obviously allocated starting in the mid 30s all the way until the mid 2040s. Still some time, but we're already seeing those early ripples from these commitment bills and these companies creating partnerships. With everything going on last year, I feel like nuclear energy kind of fell in the background closer to the end of the year, but there's still some real strong demands in the space. There's a commitment from Western governments to continue to invest and expand their production. And then even if you're just purely betting on the price of uranium going higher because of stronger demand and limited supply, you can obviously always buy the Sprott Physical Trust that just holds physical units of uranium. But you can see on the left just the amount of money that will be spent by various governments in overall into Bloomberg. There's about 2.2 trillion that is expected to be invested into global nuclear projects by 2050. So a lot of tailwinds there. Looking here, this is just a chart on web traffic data share for the overall generative AI space. You can see this, I think the chart is from mid-December, so it's a little out of date, but you can see the trend versus a year ago. OpenAI's share of this space is shrinking pretty rapidly. It's gone from about 87. It was the first chat box. It was the first thing people would look at. Kids in school were using it, university, etc. But now you get all these other chat boxes, including Grok and the Chinese DeepSeek or Perplexity, or even Gemini, which has seen the strongest growth. And Gemini is integrated across Google devices, across Google search browsers, obviously Chrome. So it's going to allow users who already are on these platforms to integrate this new technology without impacting their habits. I think this is going to continue. I think it's another leg for Alphabet to grow revenue and down the line grow earnings. And their income statement and balance sheet and their financial statements are some of the strongest in terms of the hyperscalers. So could be some trouble for OpenAI. I had mentioned this a couple weeks ago before the break, just in terms of OpenAI's warning letter to their to their staff, saying they're going to delay some monetization projects because Gemini has beaten their platform on a number of benchmarks. I don't know how they measure those. Obviously, that's people in tech, but nonetheless, a potential warning sign. I'm looking here. This is price of oil. Obviously, has fallen backwards. And this is a monthly candle chart dating back to we're sitting at about $57. We're below 60. This is where I don't think you get a lot of increase in production, a lot of CapEx from these US and North American based majors in Venezuela when they need to spend billions on CapEx just to hold production in line over the next 10 years where it is right now. And then also expanding production will cost even more. I think about 183 billion over the next, I think like 15 years to return them to that 3 million barrels per day that they previously were at. So a bit of a, I'd say, floor in terms of the price of oil. Just looking here, this is defense stocks. I'm just using General Dynamics as a proxy. We own it. I've mentioned it before. Just a snapshot from FactSet, but quite the rocky day, I'd say, for some U.S. defense stocks. Trump came out with his weird tweet and said he wants to cap salaries for defense companies, which could be a strong policy move, and then wants to restrict share purchases and dividends from those corps to spur innovations and change, and he'll monitor the situation. Shares dropped like 5-6%. And then I guess he talked to Congress, and then he announced a 50% increase to the US defense budget, and all those stocks just regained their losses. We still like General Dynamics because it's a kind of a blended approach in terms of defense and commercial with a variety of business segments, and it trades at a really attractive multiple that we really like relative to competitors. And then just last chart, talking about risks in 2026. Geopolitical pressure globally is continuing to ramp up. We had that naval standoff right off the coast of Iceland this week with the US and Russia having Russia changing a Venezuelan tanker to have a Russian flag, yada, yada, yada. But it really does seem like the heat is being turned up, and it looks like these larger countries continue to want to grow their influence, including the US, who is not just looking to make America great again. It's really turning up its policy across, I'd say, the Americas, and it might just be make North and South America great again. And then you obviously have the China risk out in Taiwan and a number of other conflicts. So potential tail risk for the rest of the year. Obviously, everyone knows that, but just what happened last Friday is, I think, last Saturday morning, something to pay really close attention to for the rest of the year, obviously. And I think that's it for me.
Yeah, that's a really powerful slide that someone's made up, a real fearmonger. And it just makes me think that the more you see things like that, the more this market will continue to just sail to higher highs. I hate to say it's like the ultimate wall of worry that this market is continuing to climb. Correct me if I'm wrong, but in past wars around the world, it really has had a momentary blip on stock prices. And then if the economy and the market's strong enough, they tend to carry on to higher highs. So personally speaking, I'm very worried about the world, like anybody should be. But, from the stock market, I don't think that's going to be what it is. I think it's going to be some other economic shock to the system, interest rate shock to the system, or something that, you only know 6 months later in hindsight when you look back. Now, maybe I'm wrong. Maybe it will be something horrible and you don't even want to think about a World War III. But yeah, I'm relieved for the Venezuelans who have been downtrodden for decades, and the Cubans next. But I'm also, you don't want to see the whole global world become unhinged because of this. Like Russia and China have been incredibly quiet about this. So I don't know maybe other people speak up. Maybe we can have just a brief discussion about Venezuela now. What are people thinking before I go into my slides?
I think it's a great day for Western imperialism. I'm very happy that they did it. It's long overdue. You'll see my cartoon at the end of my slide. I think, look at Panama. Panama today is absolutely thriving after they took out Noriega. And I think we'll see the same out of Venezuela, and then, they'll probably on their way to Greenland, somebody will tell Trump, hey, I think there's oil in Newfoundland, and they'll be like, okay, let's get those leaders. It's that Monroe Doctrine, as they call it, the Donroe Doctrine, and they said so in their recent update of their U.S., the U.S. strategy is that the Western Hemisphere is going to be theirs from top to bottom.
Yeah, no, and there's talk about China will create its own silo as well, and Russia as well, and allow Russia to really not take control of Ukraine, but have sort of economic access like the U.S. appears to have now with Venezuela, and then ultimately let China take Taiwan, which scares the heck out of me and the whole semiconductor world. I just don't, they're all empire building, all of them, and I just don't see how it ends well for the average global citizen. But you're quite right. Panama has been a nice resurgence. You still can't buy land there freehold, though. So it's just sort of land leases. We saw the problems that the Panama Canal had there with its China dominance that eked in over time. Oh, I don't know. Hopefully some diplomacy comes out of this rather than chasing oil tankers across the ocean. It's just ridiculous. But yeah, I think at the end of the day, it's going to be all about energy. AI is all about energy, crypto, everything. So, Ken, I'm happy that you're keeping such a close eye on energy, and we'll continue to ramp that up as prices, at least on the stock side, start to improve. They've started to a bit on the commodities. But anybody else have any other thoughts so I can stop rambling?
Hey, Dave. Morning, guys. Chris here. I think the one. Agree 100% with Sean's comments. Very insightful. I think as regards to Canadian dollar, I think that the oil or the potential movement of oil around puts a cap on the Canadian dollar rally. There's a lot of, the way that Trump is actually confiscating the oil and turning it into hard cash immediately is, I think sort of setting few people back. Sure, it's going to take multi-decades to revive the Venezuelan infrastructure and everything. And I don't know if the U.S. has the willingness to put in that amount of spending. It would just drive their deficit to unheard of levels. But they do have a production base, and more supply is not great for oil prices, which is certainly a pretty strong driver for the Canadian dollar. So that's what I'd like to put into the conversation, Dave. Thanks.
Yeah, no, I agree with you, Chris. And I saw Deloitte came out the other day with growth models for Canada of slowing down to I think it was 1.5% GDP growth. And Canada just has so many built-in problems, and energy could be the answer to many of them. But they just continue to not allow it to flow any more than it currently does. It's just sort of maintenance, it seems. I don't know. Hopefully something political happens there in the near future. Otherwise, it's going to dig a deeper hole for itself. But yeah, and just that on the Canadian dollar, I'm going to talk about it right now. Actually, I'll jump into my slides. But yeah, it's still looking like it's going to get weaker relative to the U.S. dollar. So we should probably put that on our radar system as well. No pun intended. Okay, now let's move on here to Michael Kuba. He took a couple weeks off over the holidays. Now he's back at it, and glad to hear you caught up with him recently, Joe, and we should get him on a sort of a 2026 Outlook podcast. He usually has some great data points. And here he's got about 20 slides that I'll try to rip through here. Fiscal impulse. The fiscal impulse is expected to peak in Q26. This surge of liquidity should bolster risk assets to begin 2026. Okay. A midterm election. So this is what everybody's going to talk about for all of this year until November. Start off a little wobbly, but then rally through April. This is probably one reason why the sell in May mantra gained so much popularity. Okay, so there's sell in May timeframe. Labor market anxiety. Consumers are clearly nervous about the labor market. For those who get bonuses, do you think they'll front load those contributions just in case they get laid off this year? Rising margin debt. Macro ops have identified the 60% year-over-year growth in New York Stock Exchange margin debt as a key warning for risk assets. We're only around 40% at present, but if we get a solid rally in Q1, we might just tip the scales. Yeah, that's very ominous, and numbers are hard to see on the bottom. That goes back to the 1950s. Those are sort of five-year increments. Yeah, used to happen a lot more on a more regular basis, but look at this run. It's really hard to see this, but arguably since 2009, bottom of the credit crisis. Yeah, we've been saying that forever. We haven't really seen any significant setback. So downside protection, I'm happy we've got that. Okay, here's valuations. It's hard to look at this data and argue the market is not wildly overvalued. So yeah, if anybody wants a copy of these slides, just send me a note and I'll share them with you. But yeah, we've been talking about this forever. Price to sales ratio. So that's all-time high going back to the year 2000. And foreign purchases of U.S. equities. And these record valuations is what has sparked a record inflow from foreign investors. FOMO much? I wasn't aware of that. That's quite significant. And that's in a year when the S&P 500 relatively underperformed the rest of the world. Investor equity allocations. Again, from a long-term perspective, buy and hold investors shouldn't be surprised if equities perform poorly over the coming decade. That's a good one. Who doesn't love stocks at record valuations? Consumer sentiment around future stock market performance tends to be a solid contrarian indicator, especially at extremes. Yeah, there's still a fair bit of euphoria out there and records amount of cash sitting on the sidelines. It's trying to find its way in. Investor stock allocations. Consumers walking the walk and talking the talk. Equity allocations mirror their rosy outlook for the stock market. Trucking capacity has collapsed as the Trump administration takes aim at foreign-born truck drivers. Now, look at that. Wow. They're getting iced. Trucking spot rates. You wouldn't know it. Spot rates jumped in response to tighter capacity, reduced employment. Now, that makes sense. Inventory levels depleted. Meanwhile, inventory levels have been bombed out. When restocking occurs, it only adds fuel to the trucking demand. So we should look at the trucking businesses, try to find one that is going to benefit. Okay, so here's some stocks here. Oh, here we go. 3,000 truck schools face shutdown in federal CDL crackdown. 3,000 of them. Wow, what a business that would have been. Another shipping. Look across the entire trucking industry. Nearly every name bottomed right around the same exact time as the compliance crackdown. Yeah, so they've already bounced back in that case. Speculator positioning. We have record short positions from oil speculators. 14 has great data at fading the CTAs. Now is the time to be monitoring for a contrarian break higher in oil prices. I agree with that. Here's Exxon. A handful of names have already begun to break out because of before the Venezuela news even became a thing. And this was while oil futures continue to grind lower. Yeah, we noticed that. Phillips, even for names that haven't broken out, most have simply stopped falling with the price of oil. Say that the equities of commodities tend to move before the actual commodity itself. And that's it. That was a good one for him for the last 3 weeks. We'll continue to get more updates from him. So let's just go to, obviously we won't have a year-to-date to be following yet. But I noticed that Algonquin Power has actually reversed itself. We own a little bit of that in one of our funds. We're going to be watching for more of a breakout to maybe buy it across many accounts. Okay, so like I say, year-to-date, it's a brand new year, obviously. All green except for Australia. The one-year numbers, which really just the December year-to-dates plus a little bit of time here. Yeah, as I said, the S&P was 17. Canada was 25 to 28 with complete outlier year on the venture exchange of almost 70%. It's amazing how quickly that 10-year average starts to catch up to the rest of the world. So, yeah, Paul Beatty, I'm not sure if you're on the call yet, but that's been very powerful for your fund. Yeah, not much else to say about that there. So crude continues to disappoint, as to natural gas. Best performing asset class, silver, 139%. I don't see that number anywhere else there. And then gold next at 59%, slightly behind the venture exchange. And I don't really see that stopping yet. It'll stop when it stops, but I think we've got some more runway there, as we do with copper. And I'll talk about Canada US dollar later. Bitcoin, look at that. It had a first negative year in some time there. I'm sure Sean will have something to say about that later. And then interest rates, I'll cover that with final comments here on point and figure. Wait, there it is. Okay, as I said earlier, the Canada US dollar, it still measures weaker on both a short-term indicator and a long-term. So from 72 where we are now down to 68 to 62. So it's good for our U.S. exposure. The U.S. dollar spot index, also called the ICE index, at 99 measures up. So it's had, as Ken's already shown, down, I think, 9.5% last year. That was even more, I think, than it's the amount that it was down in 2017 in Trump's first term. So we'll see if they can find a way to continue to push it lower. And if they do, that's going to just do nothing but benefit precious metals. Okay, I'm not going to get into all the other currencies today. Okay, so crude, the vertical price objective, I tend to look at just for sort of the trend of securities and commodities, but it's looks like it's sort of bottoming out here, so that might reverse itself soon. And nat gas still has some more downside room, whereas the producers have some upside. So, you know, you think one should follow the other, but they're not in lockstep anymore. Copper measures up, uranium way up. That's a bit of a change. So uranium will be back on people's radar again. And gold, yeah, it's right here at 4,500 and has some upside, as do the gold bug index and the Van Eck majors and even the juniors. And silver will look not so great on the futures. And look at that. Actually, silver might be topping out here with how far it got ahead of itself. So for those traders, they might want to keep an eye on their silver positions and maybe cut them back. Yeah, Bitcoin still has this crazy high target of 226,000. So we'll see what happens there. I saw Ethereum had a lot of volatility the other day, but it still measures down. I guess these year-to-date numbers must still be for 2025. We'll have to ask Ian Saunders when that clicks over to the new year. Solana measures down as well, as does the whole index. So, crypto space is still not looking that comfortable. Finishing up here on interest rates, then I'll pass it over to you, Chris, or Sean. We'll get you next. So nothing's changed here. The 2-year still at 3.5, measures down to 2 3/4. But this is changing a bit. We noticed it the last time we spoke. 5-year measures up, the 10-year measures up, and the 30-year measures down. So we've got sort of a parabolic interest rate curve. And yeah, so that shows maybe some slowing inflation, and yeah, we'll see what happens there. Maybe this is a momentary phenomenon, because I still think that there's outsized inflation in the system, perhaps not being reported exactly accurately. That's enough of me. So Sean, take it.
All right. I have to say my performance over the last year was terrible, but you know, when you're playing in the highest volatility sector, it's to be expected. The past week was okay. The past month was no fun. The past year was really no fun. And I'm still in a mode of preserving capital in the digital asset space. The crypto market's still a mess. Big picture, we pretty much got all the same tailwinds and headwinds. The new headwind in the US is the midterm elections in November, where Trump is like set to lose Congress. The Republicans are set to lose Congress. If you look at Polymarket, it's about a 79-80% probability in the betting markets that they will not retain Congress. And Trump has said that if the Democrats take Congress, he's going to get impeached, right? This is just going to be a massive amount of uncertainty. The market doesn't like uncertainty. I don't think it'll be as bad of a sell-off as the tariff tantrum, but we could be down, I don't know, 10% on all of this. And then we find out tomorrow, whether the Supreme Court allows the tariffs. If those get reversed, I mean, we're just going to be in a mess. what's going to help us is that, the Fed is definitely on track to be lowering rates. AI capital spending is still continuing. Power and electrification, oil prices are going to be lower, lower, lower. And we're going to see the Republicans try to bribe the public when the $2,000 tariff checks is going to be the first part of that. China continues to buy gold. I don't see that stopping, especially with what happened in Venezuela. So if we look over the last year, the outstanding story, gold and silver, silver is just like the tail of the dog, and China, Iran, Russia, a lot of countries are just buying gold because they don't want the US dollar to be used against them as a weapon, full stop. Economics, we're in a dovish environment. We're going to have soft quantitative easing has already started, potential yield curve control where they're going to basically fix the 10-year. We'll probably see a much steeper curve. I'm starting to think that my favorite trade right now is to be levered long the US 2-year bond. Employment continues in the low higher, low fire, but watch this space. Like we went up through 4.5% unemployment. We're at 4.6. We'll find out tomorrow where things are at. North of 4.7, guys like Jeff Gundlach are like, that's a pretty big signal that we're moving into a higher recessionary probability environment. Inflation, while currently well above the 2% target, there's a lot of chatter right now that the official stats haven't kept up with what's going on in housing, and they expect that the next few releases of CPI and PCE, we could see inflation materially lower, and that will be supportive of bonds, but also, generally supportive of maybe Trump's ego. A big change I noticed from my last report was Atlanta Fed growth GDP projection is down to 2.7 from 3.5. That's a pretty material change. Just watch this space. Things seem to be slowing down. Recession, not right now, but if this unemployment trend continues, it's probably going to land in the summer ahead of midterm elections. It's going to be interesting. The US dollar, the recent price action, and I mean very recent, is a little higher. But, as Ken noted, there's been a big sell-off in the US dollar. They want reindustrialization in the US, and to get that, they need a weak dollar. It is surprising how weak it is, given how much higher their rates are relative to the rest of the world. But it does go to the fact that it seems nobody wants to hold US dollars. Gold, I've said it before, nothing stops this train. I don't see what stops it. I think it's just going to be a grind higher, higher, higher over the year, unless for some reason we get real dollar strength. And I kind of don't see that coming. Great space to be in some of the companies, not all of them, but gold miners have just done great. Oil, as one of the biggest asset classes in the world, or biggest commodities, is just heading down. I don't know what is going to change the trajectory of oil other than the stuff going on in the electrification space. Donut Labs, one of my favorite little companies, has announced, some people would say it's a battery. Some people would say it's just a massive capacitor, but a solid state power device for their very innovative wheel architectures, where if what they're saying comes to pass, but they've got something that can charge to 80% in 5 minutes and provide range along with the best lithium ion batteries out there. So I don't know what the future, oil's not going to go away, but without sustained global growth, I just don't see a great reversal of this trend at the moment. Rates and credit, I don't have much to say here. The Fed funds, they cut the rates. There are only 2 cuts expected in 2026. And I'm going to bet that it's going to be 4. Or if there are 2, they're going to be 50s. We'll see. US equity has improved a bit. If you look at the fear gauge, we were at 36 at the last report. We've moved up. We're just on the edge of neutral. I do think that US equities are still a good story. I don't know that I'd be putting a lot of new money into US equities. It's got strong resistance at 69.50. Like we really got to go. Once we get above 7,000, there may be a big FOMO move. But the earnings trend is positive. The VIX term structure is normal, supporting a bullish trend. Breadth is good. And we see that here. We see the price uptrend with the yellow and the line moving red moving averages. We see the heat map, blue to green, short-term, midterm, long-term technical indicators are good. This pressure factor is in the middle, which indicates like just a normal market. The VIX curve is green. It's not inverted. It's nicely normal. And breadth, just a little bit of, the very fastest breadth measures are red, but everything else is showing good breadth. So that's, pretty much Goldilocks for the US equity market at this time. Now, crypto, not Goldilocks. Bear market continues basically in everything. There's kind of like a base building around Bitcoin at 90,000. The downside in my model is 45,000. We could see momentum into more rate cuts, but a bear trend is still in place. One of the things that is kind of overhanging is the lack of this Clarity Act, which was due in December, but now might be January or February. I think Trump has got a lot more things on his mind than Bitcoin. MicroStrategy was an absolute dumpster fire last year, or strategy as they now call it, down about 50%. We've got to remember all the liquidity that's supposedly coming is going to act with a lag. And the one thing I want to see is if Coinbase does get access to the US banking infrastructure, then we could see a nice reversal. But when we look at Bitcoin here, we had a slight run up at the end of the year in early January, and now we're seeing like more and more red across the heat map. We've had a couple of down days. It's just not a good environment for Bitcoin. Again, the 4-year cycle, we're in that part of the cycle traditionally where we've had pretty severe bear markets of like down 60, 70, 80%. Bitcoin long term, I still think $300,000 is where we're going. Like there's just no getting around the fact that the US is going to be debasing the currency with inflation long term, and people are moving away from the US dollars. Bitcoin seems like an obvious choice. And here's the cartoon for this week. Since the boats are coming back, have them stop in Cuba. I do think that with Rubio, Cuba is definitely next on the list, and then they'll deal with Greenland, they'll probably just try to buy it, but I don't think Trump would love anything more than to take out Cuba. And Rubio would love that as well. They would get, I don't know who would be against it other than the Russians. So, buy real estate in Cuba if you can. Anyway, that's it from me.
Yeah,
Happy
unfortunately, you can't own real estate in Cuba unless you're a Cuban. Good luck with that one. Yeah, it's quite different to liberate Cuba, and they've obviously tried it since 1962. I think that was Bay of Pigs, or 63 maybe. It's not going to be as easy as they think. Now, Cuba is going to be really hurting now because they were getting all sorts of economic support from Venezuela, and that will essentially stop. I don't know. Maybe it'll be just they'll sort of just give in to the whole, as they almost did when Obama tried to make some amends with them, and all they got out of it was some medical openness. We'll see.
If you look at what's going on in Iran right now, it looks like the Iranian regime is being overthrown in real time. No longer has any funds flowing to it, no longer has oil and supplies via Venezuela. You could see a pretty dramatic change happen there pretty quickly, and the US is right there to support it. So it wouldn't surprise me. And when you look at the US doctrine of they want Western Hemisphere supremacy, there's just no question that they are going to go from Greenland, Cuba, Venezuela, maybe a bit of Canada. We'll see.
Yeah, Greenland, I just don't see happening. Like, how do you put a value on a vast piece of land like that the resources haven't even been fully noted, and they'll just throw them a stink bid offer, like so much per citizen, like 50,000 people, give them $1 million each, and then the citizens might just say, fine, let's do this. But I don't see how Denmark and the rest of Europe will ever agree to that. I just don't see how you put a price on it.
Yeah, I mean, they'll be kicking and screaming about it, but like the US did it with Alaska, they did it with the Louisiana Purchase. Like it's kind of in their history, and Trump as a deal maker, they'll figure something out. Because if it's give Greenland or lose NATO, right? Lose the United States presence in NATO, and maybe there's like some ongoing royalty and like blah, blah, blah. But it seems like he's getting whatever he wants, and he knows he's got until November to do it. After November, like he could be out.
Yeah.
So
or
anyway, that's it
for sure. Yeah, that's great, Sean. Good one. So Chris Curry, over to you.
Thank you. Thanks, guys, and Happy New Year. already talked about the Canadian dollar and my thoughts on that. But back to the Venezuelan oil, and I think that's one way to look at it is it's positive for the U.S. inflation numbers because that's oil that's current production is oil that's hitting the market, not going into the black hole of China or Russia. So that's more barrels onto the market, which may be a drop in the bucket, but still perception wise, could be significant. But offsetting that, the U.S. if you look at the deficit figures recently, the spending it's frightening. It's just well, that's all I can say. And so that's caused, I think, the long end of the bond market to be more or less uninvestable. Nobody wants to touch it. Prices there are falling, yields are rising in the long end. The U.S. has a real problem. They criticized Janet Yellen for, in COVID when rates are at zero for funding in the treasury bill market, but that's really all that's left for the U.S. is the very short-term money market because the deficits there's no sign of those getting under control. Just lastly, February is a new target for a Fed chair to be nominated. I'm still expecting Bessent to have a role in this somehow. I think he's the sort of dark horse. The other candidates, they rise and they fall, but he's the Mr. Steady in the background, and I think well respected by Trump. The last thing, it just strikes me like I shake my head at why Carney's going to China. The optics of that, it's just terrible. Like if he hopes to, increase his bargaining on the USMCA, a token dinner in China, it does nothing. I really shake my head at what the amount of travel the guy's doing and just, glad handing, going to these press conferences. I really got to shake my head at that. And on that note, pass it back to you, Dave.
Okay, thanks, Chris. Any thoughts on interest rates in the future? Like, where do you see them going? I gave a quick overview there about them coming down on the short end and the long end and up in the middle. I don't know if that's going to happen or not, but that's what at least the
I don't see. The 30-year I think is going higher. People. We may see a brief move down in the inflation numbers, so we might see a brief rally, but. That I did see a news brief that, Saudis are pushing OPEC for $90 oil, which is, which would be a disaster, as you can imagine. But everybody's sort of looking for, the boogeyman in the closet to what's going to crack the equity market. I'd look at the, the funding market for U.S. debt. And, if it chokes up in the, in the 10-year and it's certainly there, I think in the 30-year, they're not issuing, anything there. That could be a major issue. Sean's covered very well the rise in Japanese yields, which are, percentage wise, astronomical.
How have they ever stomached that? Like, how have they been able to afford that when most of their debt and that was owned internally? How can they afford such higher rates? Obviously, they're trying to stomp out inflation, but how can the system afford it, or are they just printing more money?
On an absolute level, the rates are still pretty low.
I guess I think the 10 to the 30s at 3.5, which is around where U.S. rates are. The currency is always a good escape valve for these things as well. So, and there's a lot of people in Japan that like higher rates because it's a real saver society. And, so isn't the post office pension is like one of the largest investors in Japan. And, I think they have a fairly conservative asset mix. So, it's good to see market forces get rid of this, yield curve control, which is, never really works. But Sean has pointed out very accurately that, Japanese carry trade is, I'm sure causing a lot of pain, which, we haven't seen surface yet, but it will when the December hedge fund reports go out. Somebody's got to be at the wrong end of that trade.
Yeah. Sean, you're trying to say something a second ago?
Sorry, I was just saying that on an absolute level, the rates are still pretty low and they've benefited for a long time. It's like internally, like they're in surplus, right? They've got trade surplus, they have current account surplus. The biggest thing with Japan is because of their demographics, right? So many people on fixed incomes. Inflation is the real bogeyman there, the real boogeyman, right? Like deflation has served that country incredibly well for a long time, because if you're on a fixed income and prices are going down, like, you're winning. So we may just see like continual political upheaval there, but ultimately they're not on a great course. They're not as engaged in electrification to the same degree as China. BYD has now surpassed Tesla for global sales and is making great inroads in Europe. Everyone I know that goes to Europe comes back talking to me about the Chinese EVs that they've seen there. So that's not going to bode well for like this massive, petro car manufacturing complex in Japan.
Okay, well, that's insightful. Let's finish up here, Gilbert. As always, last but not least, take us through what you're seeing.
Okay, so this is the just a short report here for Thursday, January 8th. Again, a general disclaimer here. One thing to note, again, the S&P 500 remains really elevated here, well above this 50-week exponential moving average. Sorry, the 200-week exponential moving average. But if we take a closer look here, you can see that we've now essentially been in this sideways movement since late September, early October here, which is not very different. Again, I'm not forecasting anything like what we saw at the beginning of last year, but we've had that sort of sideways action here. Made a new all-time high, I think, yesterday, if I'm not mistaken, or the day before, in the S&P 500, similar to what we saw in early 2025, as Ken properly noted earlier in the call. The VIX does look like it is one geopolitical event away from exploding a bit higher, and that's really the way the VIX does work. It kind of acts like a coiled spring before it moves higher. Taking a look at the CAPE ratio, we're still pushing again higher to those highs that we saw in the 2000 bubble, moving higher. Again, one thing to note is that in 2000, it stayed up there for quite some time. That's about a 12-month period where it was kind of going back and forth before the market really rolled over. And so, we are pushing higher, but we're not looking at something similar to what we saw in COVID, more likely something in 2022, or even a move like this. Credit spreads remain very, very tight, historically speaking, and so we can note that previously, when we've been down at this level, this was essentially not the time to go long. It was probably a time to be a little bit more conservative here. One thing I want to point out specifically, it is the start of the new year, and we are in the midterm year. And so there's a couple things to note about midterm election years, as they offer the lowest returns in presidential cycles going all the way back to 1950. You can see in a midterm year, the past 10 cycles, we've only had a 2% return in the market, and cycles since 1950, it's only been a 4% return. So all things being equal, historically, midterms are not good. And I think it was rightly pointed out earlier in this call that has a lot to do with specific volatility that takes place in midterm years. But I think especially with the president that's in charge right now, there's a lot of potential for that. What's even more important here is when we take a look at the S&P 500 average intra-year pullback, the midterm year also shows the most downside potential here. A minus 17.5% is the average intra-year pullback. However, the return after the lows is also the highest. Again, midterm years offer the highest level of volatility and potential drawdowns. And so as we start the year, especially after 3 consecutive years of positive returns, 2023, 24, and 25, I think it's important to really make note of this. And if you are concerned about that, if you're watching, this does provide a solution for that. And so if this does fit your profile, again, reach out to MacNicol & Associates and we can do that. Okay, that's it for me for today.
Okay, Gilbert, thanks a lot. Have a good day.
Thanks for listening to Lighthouse Outlook. If this conversation sparked a new perspective, share it with someone who thinks differently. Subscribe for fresh episodes every 2 weeks and visit MacNicolasset.com to learn more.